Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video we're going to talk about dividend kings. I've got 10 companies that are dividend kings that I'm going to share with you guys today. Some are slightly overvalued, some are undervalued, some are fairly valued. So this mixture right now in terms of valuation side of it, but we need to talk about dividend kings because one of the things that I've always been advocating for is that passive income. And I've always said to people, I love investing in ETFs. Right now, the Sharia compliant ETFs, in basically majority of them don't actually pay dividends. I like the paycheck. I like to basically reinvest that by myself. I've got a lot more time to invest, a lot more time to research and so on. Individual stocks that can be difficult, and for me, I just like to basically invest in dividend growth companies because these are companies, first of all, that pay steady income stream. They're potentially basically great for long-term growth because what they're doing is if they're paying you $5 now, in 10 years, they'll probably be paying you double that because they grow that dividend every single year. The risk is slightly lower because dividend paying stocks are typically less volatile than non-dividend paying stocks, which is quite nice to see. And I've seen that in first hand in 2022, when the stock market was going down quite a lot. The companies that actually were performing better were the energy companies, there were consumer staples, companies like healthcare companies. All of these kind of defensive stocks were doing really well basically during that time. And that's one of the reasons I actually like the fact that buying an ETF will probably be better because you sleep well at night, not basically caring about whether the stock market goes up or down, where you're not worried about individual stocks, you're not reading reports and all sorts of things, right? But the good thing is, if you invest in individual stocks that are like, for example, dividend growth companies, you can sleep well at night without basically having to worry too much about it. Having said that, there are some horrible companies out there, and that's why I focus on dividend aristocrats, dividend kings, companies that have increased that dividend and still are profitable businesses. So what I'm going to do now is share with you guys 10 companies that are still profitable, doing well, and of course they're top of their game when it comes to that dividend paying side of things. Now it takes a lot of time and basically to put these videos together to share with you guys regularly, so I would genuinely appreciate if you can just like the video, subscribe, of course, let me know if you have any comments, and at the same time if you can join us in the Patreon account where you get access to a lot of things, including the family portfolios and the dividend trackers, the undervalued stocks, and then Discord where a lot of brothers are sharing very good practices on a daily basis. Now let's have a look at these 10 companies. So the information that we're after is still more or less the same: the market cap, the moat, the price of the company, the dividend side of things. We're also looking for how profitable the business is, how they're actually managing that money, with the return on equity, return on investor capital, things like that. We're looking for free cash flow because we want to make sure these companies have a growing dividends and they can pay off that dividend. If a company has a negative free cash flow, then there is a question mark when it comes to being able to increase that dividend in the next whatever years. We want to see where the company has been over the last 10 years, and we want to see where they're heading in the next basically year with regards to basically EPS or earnings per share, as well as the revenue side of things. And we will be looking at the Morningstar valuation, which I've always said to you guys, I find that it has a bit more margin of safety in comparison to other companies or other basically companies that use similar sort of methods to evaluate stocks. The first company we're looking at today, I'm not going to read everything, so I'm going to skim through it because I don't want to make the video any longer than it needs to be. The first one is basically S&P Global. This is probably one of the best companies out there, credit rating company out there. Basically, they've got a lot of the indices. They've got all types of business, even including some tech stuff that they actually do. Now, it has a wide moat, and I think this is probably one of the basically 2 or 3 companies in that field that kind of monopolize that market. Now, as you can see, the dividend is not huge, and a lot of these companies might not have a huge dividends, but what they do have is the growth, and this is the column that we will be focusing more because these companies are dividend kings, if you like. Now, the latest increase was not great, but the 5-year growth rate of 12%. Now, this is important to me. Like, for example, I don't even care how many years they've been increasing, but I want to know basically the last 5 years, are they increasing double digits? And if that is the case, it's absolutely amazing. Normally I look for 6%. and above. So anything basically higher than 6% is really good for me anyway. And the safety is 99%, return on equity, return on invested capital, profit margins, all of that is fine. And the free cash flow is really, really good. Now it's fairly valued right now, and they are expected to grow decent. So 10% EPS, 7% revenue side of it, fairly valued, $480 per share. And actually, according to Wall Street, it is actually strong buy right now, 14 strong buys, 7 buys, 2 holds and 0 sells. And as you can see, it's about 14% upside from where we are right now, which is interesting if you think about, but fairly valued according to Morningstar. Wall Street can sometimes be a little bit too keen on the certain stocks and so on. The next one is Parker-Hannifin. This company basically has the basically very low payout ratio. Latest increase was really nice, 10%. The 5-year growth rate of 14%, and 68 years of increase in that dividend. Think about all the stuff that happened over the last 68 years. None of that affected this company, and this is what I meant at the beginning when I said you get that stable income and you don't have to really worry about it, because if we're in a recession, these companies do increase that dividend and so on, and they do have excellent free cash flow. And as you can see here, they're expected to grow decent next year, but however, they are very, very expensive right now. $450 per share is where they think the price should be. And again, looking at morning Seeking Alpha, as you can see here, we've got 14 strong buys, 3 buys, and then 4 holds and 1 strong sell. And it's about 12-13% upside from where we are. Like I said to you guys, sometimes Wall Street can be a little bit optimistic about certain stocks. Now the next one is Grainger. This company, funny enough, has been on my radar for a very, very long time, and every year I'm like, I'm gonna get it. Look at it now, 66% premium right now. It's always been like that, to be honest with you. I really like the business model, but hey, I like industrials for some reason, but this company has not come down whatever years. But the payout ratio is very low. They've increased that for 52 years. The 6% in terms of the last 5 years growth and dividend growth side of things, and $1.8 billion of free cash flow. They expect it to grow decent next year, but it is, like I said, very, very expensive. And I think this is something that's basically also Wall Street agrees. We've got 16 holds, so overall a hold right now. And the next company we're looking is Automatic Data Processing, 120 billion market cap, wide economic moat. In terms of dividend, we're about 60% right now for the payout ratio. The 5-year growth rate of 12%, which is really good. 50 years of increase in that dividend. Over $5 billion of free cash flow. They expect it to grow 9% in terms of EPS, 6% in terms of revenue, and you can see here fairly valued right now. $280 per share is $296 right now. If we go here, APD or ADP, the other way around, you will see the fact that it's actually a hold as well. Okay, the next one, like I said, some of them are very expensive. The next one is Lowe. Lowe is another company that I used to own in my portfolio. Sold a while ago because the interest-bearing debt, I think, was slightly too high. But yeah, it has paid off a lot of that debt recently, so which is really nice to see. The payout ratio is only 38%, and the 5-year we're looking about 19%, and 63 years of increase in that dividend. When it comes to free cash flow, over $7 billion, and they are expected to grow about 5% in terms of revenue, and EPS in terms of revenue about 2%, 14% premium right now. If we look at Lowe's in here as well, you will see basically Wall Street is about 17 strong buys, 4 buys, 14 holds, 2 sells, and 1 strong sell. So they've got everything basically. 9% upside from where we are right now. The next one we are going to look at today is AbbVie. This is another one that has been on my watch list for quite some time. As you can see here, in terms of dividend is probably the highest that we've seen so far. 3.8 dividend the yield in terms of the yield side of things, 58% in terms of payout ratio, and in 5-year growth rate, basically we're looking at about 9%. 52 years of increase in that dividend, over $15 billion of free cash flow, and they're expecting to grow nicely next year. And as you can see here, basically it's fairly valued. And if we check here, ABBV, you will see that it's actually a buy right now. 12 strong buys, 6 buys, 10 holds, and about 15, 17, 16% upside from where we are right now. The next one we're going to look at today is Illinois Tools Works. Again, another one that's been on my watch list and made my radar for quite some time. Another industrial company. As you can see, it has a wide moat. Payout ratio only 57%. I don't mind anything below 60%. The latest is about 7%. The 5-year growth rate basically 9%. And as you can see here, the free cash flow, like right now, we're looking at $2.7 billion, which is quite nice. They're expecting the earnings to grow about basically 5%, 2% when it comes to revenue, 18% premium right now. ITW. Let's see what Wall Street is saying. It's hold for them, 13 holds. The rest are either sales and so on. It's about 33% upside from where we are. The next one that we're looking at today is MSA Safety. This is one of the companies that I haven't come across basically until I did this research. So it's a very small 6.4 billion market cap. And as you can see here, the payout ratio is very, very low, and the 5-year growth rate is about 5%. 57 years of increasing that dividend, which is absolutely huge for a small company. And based on almost 300 million in terms of free cash flow for a company that's 6 billion, that's not actually bad. In terms of market cap, EPS 4%, expected to grow for about 4%. Revenue is about 3%, fairly valued right now. MSA is the company, so MSA. Let's have a look at what Wall Street thinks of this company. Whoa! So we got Seeking Alpha analyst saying it's a sell. Wall Street is saying it's a buy. Quants is saying it's a hold. So you get everything. 3 strong buys, 2 holds. And right now they're expecting about 21% upside. $199 per share is where they think the price should be. Right now is 160 something. Okay. Next one is Nordson. This is another company that I came across very recently, about $12 billion in terms of market cap, wide moat. In terms of payout ratio, only 29%, so it's really nice. 62 years of increase in that dividend. Again, $12 billion, but they have got about half a billion of in terms of free cash flow. 12% when it comes to the total return in the last 10 years. EPS they expected about 9% growth this year, and then revenue is about 5%, 14% discounted right now. And if we go to Seeking Alpha, as you can see, what Quant is saying is actually sell. Wall Street is a buy. Another one that's very mixed. So 2 strong buys, 3 buys, 5 holds, and we've got about 20% upside from where we are right now. Okay, the final company we're going to talk about today is ABT, Abbott Laboratories. Basically, it's the AbbVie is a spin-off of this company. So again, they more or less kind of have the similar matrix when you look at the years of increasing, because this one inherited basically the years from this company, of course. And as you can see, 49% when it comes to the payout ratio, 52 years of increase in that dividend, and you've got over $6 billion in terms of free cash flow. And basically EPS is expected to grow about 10%, 7% when it comes to revenue, fairly value right now. So this is actually growing really nicely. If we go to Seeking Alpha ABT, you will see that it is basically a buy right now from Wall Street. So with 13 strong buys, 8 buys, 6 holds, and overall about 15% upside from where we are. Now I'm going to very quickly show you the Sharia compliance side of things, because I don't want to make the video any longer than it needs to be. There you go. You can pause the video and have a look at this. This comes from Zoya Sharia Compliant. They use these standards, and all of that information came from the app that I use, which is called Zoya. I have no affiliation. I just use the app by myself. No contact and nothing with them. If you can join us at the Patreon account, that would be absolutely amazing. A lot of these basically this research takes so much time. I would generally appreciate if you can actually join us. And like I said to you at the beginning, these are sleep well at night kind of companies, but of course you really need to do deeper. This is kind of giving you an overview. You just need to do a little bit more research to find out more information about the company. If you enjoy this type of content, please join us at the Patreon account or wherever. Have a wonderful day. Assalamu Alaikum.